Welcome, guys. Welcome to the ARMR Report. I'm your host, Brett Rosenthal. This is a show about stock market investing in the millennial age. We use traditional fundamental analysis to uncover themes and individual stocks we want to own, and we use algorithms and other millennial tools to help us execute. So it's the combining of those two processes that makes us successful, and we share them with you every day at 12 o'clock. This is a live trading desk. So while I'm doing this, I'm surrounded by screens that are telling me what's going on today, and some of which are automated algorithms and some of which are algorithmic direction, if you will, with still human interaction. We manage 3 different portfolios, all of which are at Interactive Brokers. We link client accounts to them, conservative, balanced, and aggressive. You can imagine what that means. All of it's equity investing. We use exchange-traded funds for primarily all of our investment, except for when we're buying individual stocks. So when I talk about the S&P, the NASDAQ, the Dow, the small cap, the momentum index, when we invest in those things, we're buying ETFs. And all the groups that we focus on. We're not buying futures, or anything like that. And, we don't use options here except for rarely. Sometimes we will to hedge positions. So I look a little bit concerned right now. It's all around me. The market is real red, and it's been a straight down morning. So let's jump right into what we like to do. Is we like to look at our big indexes. I always share with you that we build our portfolios like this pyramid, the bottom layer being the strongest layer, and it's the five big indexes: SPY, QQQ, DIA, IWM, and MTUM. So it's momentum index, small cap, the Dow, the NASDAQ 100, and the S&P. That's our core. When our algorithms tell us to get risk on the market, we start there. So we knew last week before the Fed comments, we were getting long small cap and the NASDAQ 100. The day of the Fed comments that were considered to be dovish, the market was up 2%. We got a follow-through confirmation across the board. So all of our big indexes told us our algorithms told us it's time to start putting risk on in the market. And the way you could use that as an investor is to take that knowledge, take that information, and help it direct your risk management. So when we say on this podcast and on the live stream on YouTube that we're risk on, I get guys asking me, well, do I just buy the indexes? You can do whatever you want. In a conservative account, we just buy the big indexes. And that way we get rid of single stock risk, and we get rid of group risk, and we're just risk on equities. In an aggressive account, we're buying those indexes, but we're also layering in groups by buying ETFs of our favorite groups like cannabis stocks. And then we're taking it a step further and buying our favorite names inside the cannabis space, as an example. So last week it's risk on. Now, I told you all yesterday, our show yesterday was all about avoiding jumping in and adding risk and avoiding greed on a gap up Monday morning because of all the excitement of the G20 meeting. I said that's the wrong time to put money to work. Please do not do that. Step away from your desk. Go for a walk on the beach. Do something else, because a gap up Monday morning is usually dangerous. And what do we have today? An ass kicking that's reversing the entire gap up a Monday morning, right? This is not hard, guys. This is not hard. You buy weakness, you sell into strength. You have to commit capital before everybody thinks it's the right idea. And when everyone's diving in on a gap up Monday morning because Donald Trump done something that everyone thinks is great, we're not adding to positions. We're not selling them either. But every one of our positions hit their raise stop targets. And that told us, okay, now we can raise our stop, wall off our risk, and see how far this buy signal is going to go. Today, the trading is really ugly. But I did say yesterday to you that it's typical when we have that initial run up to have a sell-off day that shakes the tree to see if people are going to let go. As my friend Bill Jacobs likes to say, my friend and partner, the market's always trying to get you off the bus. So here's that day, real nasty selling. What's the reason for it? Whole host of reasons. It has nothing to do with Trump. It has nothing to do with trade, even though that's what they like to tell you on CNBC. It has everything to do with the Fed and yield curve inversion. And they are covering that on CNBC. Rick Santelli is doing a great job. A different Fed member came out today, Fed Williams, I think he's the New York Fed chair, talked about how they're going to have to raise rates more in 2019. And in the meantime, the yield curve's inverting, which tells you that there's a recession coming. And so how do you have yield curve inversion and continued rate hikes? It's going to be very difficult on the market. And so here's the shaking of the tree. So we put positions on last week in front of all this excitement, which allowed us to be in a profitable position today, albeit we're giving back about half of those gains. But we're now in a position where we can wall off our risk. If we close below stops today, we're going to be selling positions and raising cash again. If the market holds here, reverses, goes higher by the end of the day, then we'll be holding on to positions into the closed market tomorrow. Market's closed tomorrow because of the funeral of the former President George Bush. We're accelerating lower right now. It's happening on volume, which is definitely problematic. So we've completely closed the gap from the excitement. But I would stress again, it's the close of the day that matters. It's not the action that happens in the morning that tries to get you off the bus. If this action holds all throughout the day and there's no recovery, then maybe we'll have to change our position. Right now, we're not doing that. The S&P just had volume as it went back below the 200-day moving average. So here's the play. Here's the fight. Are there buyers that are going to come in here as the volume comes in and pushes it back below the 200-day? Or, are we going to hit our raise stop across the board and get out of everything by the close? I don't know. Stay tuned. Stay tuned to my Twitter feed. It's at Brett Rosenthal, B-R-E-T Rosenthal, or hashtag ARMR Report, ARMR Report. Don't forget, ARMR stands for Algorithmic Risk Management Research. This is the hardest part of the process. You put a bunch of capital to work and you're hoping for success. You're hoping for a big move in the market, and hope's a killer. Hope has nothing to do with investing. Your ego has nothing to do with investing. You put capital to work when the probabilities are in your favor, which it was last week, and then you raise stops and protect that capital as you move forward. If those stops are hit, you go back to cash, you take a break, and try to figure out what's going on. Protect your capital. And you can't worry, what if I get out and then the market goes up next week? Hey, sometimes that happens. This is about statistics and probabilities. It's about putting capital to work when reward is worth the risk. Risk gets too high, got to protect capital. Take a step back. If we get stopped out across the board on every index today, that's a major, major concern. It means you've got to protect your capital, and whatever that means for you as an investor. Maybe your max cash position is 25% and you like to stay mostly invested all the time. Okay, well, if all 5 indexes get stopped out, you better have 25% cash at the end of the day. That's what our algorithms are telling you. That's the information that I'm sharing with you right off our trading desk. But we don't execute at 12 o'clock on what looks like a market implosion as volume comes in, takes us back below the 200-day moving average. We don't execute in the midst of the mayhem because the market's always trying to get you off the bus. And very often, we'll see if this is true today, very often when the volume finally comes in, so we've had selling all morning, and in the last 6 minutes, we've had volume selling. So you would think we got to get out. The volume's coming in. The volume's coming in. It's not like that. That's what it used to be 20 years ago, 10 years ago even. But after 2008, the world changed. Algorithms took over after 2008, after the financial crisis. And very often, the acceleration of volume in a market move ends up being the bottom of the move. And by 4 o'clock today, the market will be trading higher than where it originally had volume coming out. It's all designed to shake you off the bus. Now, sometimes that's not the case. I'm talking probabilities and statistics. I'm always trying to get on the right side of the probabilities. Statistically speaking, if you've been selling all day and the volume comes in, that's marking the bottom. Maybe 9 out of 10 times. Today could be the one out of 10 where the market just crashes. It's possible, but I can't run money worrying about crashes because then I'm constantly on the wrong side of statistics. And over time, you lose money that way. Even though it feels good because you're tickling the fear response. You're saying, oh my God, here's what's happening. I got to get out. And you look back 9 times out of 10 and say, why did I do that? Step away, be patient, recognize the time of day, and then execute without any emotion at the correct times of day. That's what we do on our trading desk, and I'm trying to share that information with you whenever I can. So today is typical, I'll be honest with you. In any new risk-on entry point, there is always a day of testing. So to wrap up this segment of the show, it's not that surprising. There's a day of testing. I don't like how it's behaving. This test is pretty ugly. We're already below our raised stop on the small cap index. So once again, the sector of the market that's been leading the market for the last couple of months is small caps, and it's leading again today on the downside in a big way. So if small caps don't recover from here in a big way before the close, we're going to be out of small caps, and that would really temper my enthusiasm on the market. Because if small caps continue to get killed like this, it tells you there's something wrong with the market. Right now, small caps are down 2.5%. You know, the S&P is down 1.5%. So that's a big excess move. And it was the first index to really implode today. I mean, it's just gone straight down with almost zero lift. It's been going straight down since the open with zero lift. We are now on our intraday algorithmic charts. We are at the very, very lowest possible statistical line that we would see on an intraday basis on the small cap index. And what that means to me is, okay, 1 out of 100 times we're going to crash, and so the market will just keep crashing. But statistically speaking, right now we're at a point where I would be surprised if the market closed lower than this on the small caps. I'd be surprised. But it sure is a nasty sell-off right now. I mean, it's just, wow, straight down. Okay, well, that's just the way it'll go. We'll react accordingly, but we're not going to react in the teeth of it. I know this is a hard thing to understand if you're an intraday trader or if you're investing on the shorter term. If you're a long-term buy and holder, then it's pretty easy to say, okay, I'll wait till the right time of day. If we're below stops, we'll get out of whatever position we want to raise cash with, and we'll hold the core. If you're more aggressive and you're staring at the screen all day long, it's very hard to be sanguine when the market's selling off this hard. But I will tell you, statistically speaking, if you do that every day of the trading year, you'll come out ahead. If you panic in the midst of this action, generally you lose a lot more money over time. And I do think that this selling is all related to the yield curve inversion at the very same time that a major Fed chair of New York, is talking about more rate hikes in 2019. So if you think that the market rallied because last week Chairman Powell was dovish, now you got another Fed chair coming out, not as senior as Powell, but still an important Fed chair talking very hawkish. And so the market decides to test the bulls. Okay. In the meantime, and it's getting uglier and uglier as we speak, so it's a little bit hard to maintain my focus. I'm just looking through all my different processes just to see if did I miss any piece of news recently that's come out. I don't think so. No, it's just the air coming out of the market after a run up, after news that was expected, with Fed chairman talking more aggressively. That's what's going on. Tomorrow the market's closed, so it's a thinner market right now. People are trying to figure out how to square their positions before the market's closed tomorrow. All right, we'll see where we are at the end of the day. It is what it is. Let's skip over before the show ends to our favorite group. I'm going to keep talking about the cannabis stocks, the marijuana stocks. And they might get wiped out today in the sell-off, and we might have to go back to cashing here. And we'll do that on the cannabis stocks. If we have to do it, we'll do it. We may keep a core of our favorite names. One of our favorite names is Cronos. We've been talking about that for a while. Canopy, another favorite name. I do think it's important to go over the cannabis stocks a little bit and just focus. You could check my Twitter feed. You could see what I've been saying to Ken Steele, who's asking questions about Cronos and Canopy. Wants to know which one's a better buy in the short term. Honestly, Ken, I think both of them are a great buy. Now, if they break below stops, I'll be out of those positions and I'll wait for the next opportunity, or I'll reduce the position dramatically and just hold a core. But what we're trying to do on our trading desk is research on cannabis companies, and we're trying to find the companies that are adding value to the cannabis story. Not just the growers of hemp, not just the guys who are extracting it and selling it, but the guys who have intellectual property that are taking CBD, that are taking the THC, that are wrapping it up in a proprietary product and selling it with a high average selling price, or ASP. That's what Wall Street wants. That's what Wall Street pays for. High margin business. And the best way to understand the cannabis opportunity as an investment is to look at the sugarcane business of the 1800s, 1900s, and look at what were the best investments at that time. That's what this is. It's a cash crop. Where's the best place to put capital? You could have bought sugarcane property and produced cane. I mean, certainly that worked for a certain extent, but it became a commodity. Anybody could do it. So it obviously gets overgrown at some point. And then you have the guys that extracted sugar and put it into a bag and sold it for someone to use in coffee and tea. And that was good, but there was no proprietary IP. Anybody could extract sugar from cane. It was pretty simple to figure out. And so again, that got commoditized. But the company with the best investment opportunity was the company that took sugar, put it into a carbonated beverage, called it Coca-Cola, and sold it at a high average selling price. High margins. Coca-Cola was one of the best investments in the 1900s. Was it the 1950s? We can go back and we'll look. But that's the idea. Find the company that's creating the next Coke, that's taking the CBD or THC or something like that, putting it into a product with high intellectual property so that they dominate the space and can sell it at a high average selling price. That's why Constellation Brands put $4 billion into Canopy. So you asked me, is Canopy or Cronos the better investment? They're both great investments. I mean, Canopy already has the war chest. And ultimately, this is going to be about who's first to market and who builds a brand. Canopy's got $4 billion. So that's a kind of a safer investment, really. And then Kronos to me is, it's Canopy before this Constellation Brands investment. They're creating IP. They got worldwide reach. Will they get some type of Canopy style investment from Altria, right? That's what we found out yesterday. They're in talks with Altria. We don't know what they're going to do. Altria could take them over. They could make an investment in them. We don't know. But if Altria does that and puts them on the map, so to me, both stocks. And MJ is the ETF that we favor when it comes to owning cannabis companies. Now, I mean, look, MJ is getting whacked with the rest of the market right now. So, if the market closes down here, we're going to have to concern ourselves more with walling off risk than taking investment, opportunities. So we'll reduce our exposure. We'll stick probably, depending on the type of portfolio we're running, with core positions and our favorite investment ideas, but we'll have a bunch of cash on hand to protect us if this sell-off really gets out of hand the rest of December. And you're just going to have to stay tuned. I'll be off the desk tomorrow. The market's closed, but I'll come back and do this live stream for you on Thursday, and we'll have a better idea of where we are in the market. I will update our website, rosenthalcapital.com. We have a real-time risk-on, risk-off monitor. So by the end of today, if things have changed, I'll be updating that monitor, telling you which indexes have violated their stops and where we've raised cash. And I'll try to update you on Twitter as well. So, generally before 4 o'clock, depending on how busy I am, managing my own capital, I'll try to update you on Twitter. It's #ARMR report. And I'll update the website so you know where we're at. And then we'll talk about it on Thursday, changes that we've made and what we think is happening in the market and what our algorithms are telling us. Okay. But I'm gonna sign off for right now and get back to the market environment. It is a little bit hairy, and I got work to do. And so I'll check back in with you on Twitter later today and give you some more feedback on what our algorithms are saying. Thanks for joining me. This always helps me. Hopefully I'm helping you, but it certainly helps me stay disciplined, make sure I execute the way I'm supposed to. I hope it helps you. And I look forward to talking to you again on Thursday. Take care, guys. Good luck today. Be safe.